20% of my small private portfolio is going to fail.
Welcome back to James Talks. You may recognize that as Kevin O'Leary, Mr. Wonderful, off of Shark Tank most famously. And as you heard here, he's decided that 20% of his bricks and mortars business are going to go under. And he's not going to miss words about it. We'll get into that more in a second. First, I wanted to just say thank you to everyone that watched episode 1, where I talked about balanced portfolio, and all the feedback I got was wonderful. Thank you so much for everybody that watched that and left a comment, liked it, subscribed to the channel. It was really wonderful to see everyone get back to me. So thank you very much. I wanted to also just share a little bit about what I thought this channel could be, because it's a little bit interesting. One, I wanted this to really be a conversation about investing, what to do, how to do it, and follow along as I go through investing. So in America, at least my experience is there's not a lot of people that actually talk about what they're actually investing in right now, what it looks like, how they think about things. There's a lot of what I perceive as some ulterior motives on finance channels, and I want this to really just be one man's opinion. I'm not a financial advisor. This isn't financial advice. So if you're looking for financial advice, I really recommend you go to a financial advisor. I use them. I think they're worth the investment. This is not what this is going to be. So what I would like this to be is more just a casual conversation, and to give you a front row seat as I'm making actual investments, and share each week something I think is interesting, something that I think is relevant for investors, for ways to think about businesses, or to give you one perspective, mine, about what that might look like for the future. So this week I'll go through a portfolio that I've been following and investing in for the last 6-7 months now, and you can get a glimpse of what I think about and how I try to make things easy on myself. And then finally, I wanted to go over a little bit around fees, and why fees are important, and why small numbers can have a humongous impact over the life of your portfolio. So stick around. But first, let's jump back to Kevin O'Leary and hear a little bit more about what he said in this past week.
It's going to fail. They're going to zero. They are in restaurants. They are in sports entertainment. They're anything doing, movie theaters, all that stuff, gyms, going to zero. I don't want to support them anymore, and I don't think the government should either. Let those guys die. They have to die, because the consumer is moving into a different direction. But where the consumer is going is being empowered by the Facebooks, by the Microsofts, by all of these tech companies. Amazon, are you kidding? That's a must-have for...
There you have it. 20% of bricks and mortar businesses are going to fail, according to Kevin. Movie theaters, gyms, restaurants, and I think that is going to be the truth in some respects for the next 6-12 months. It's going to be very difficult to survive in this environment. But I think gyms will survive. I think restaurants, good ones, will survive. They will find a way. I think that it's premature to think, hey, in 6 months or a year, we're not going to want to go to a movie theater or go out to a restaurant. So as a long-term investor, when I hear things like that, let them go to zero. Don't worry about investing in them. I think there's probably going to be opportunity there before you know it, because by the time some of them are going out of business, new ones will open up, and people will recover from what we've been living through and want to get out of their house, right? Like, if you have kids in your house right now, you are looking to get out. You are not like, and in my situation, that is us. You want to go somewhere. You want to get out with the wife and go out to eat and go to a movie. So there will be pent up demand for exactly these things. And there's just some things that you don't want to do online. I think the market this week reacted really strongly to earnings from big tech companies, and that's okay. And I think people have money they have to invest. They have to put it somewhere. and they're scared. So the way I think about this, though, is more of a long term. What's going to happen in the next 5-10 years? Will the next year be rough? Yeah. It's going to be more of the same as what we've seen over the last 5-6 months. Is it going to be annihilation for all bricks and mortar businesses? Is the CrossFit gym you went to going under? I don't think so. Next, let's go through a portfolio update. So this is a portfolio I started back in January of this year. It's got 2 holdings. You'll see Vanguard Midcap Index Fund and Tesla. So 2 things I'd say about this. Right now, the holdings are at $77,408, which to me is a lot of money. The purpose of this portfolio is to be easy and to grow. So why I picked the mid caps, if you haven't heard me talk about it before, is basically I've got a strong belief in medium-sized companies outperforming large companies over the long term. That's bared out over the last 20 years. I think it'll continue as small companies figure out new ways to serve customers faster than most large companies. Not all of them, but most of them. And then the second holding here is Tesla. And really the reason for Tesla is I'm a huge bull on Tesla. I think Elon is a once in a lifetime CEO for the company and can really take that as both an energy EV company, self-driving. I am all in on Tesla, and the backstory was Tesla was down to $500 in the middle of March, and I was like, this is the time to buy in, right when everything was getting really bad with the pandemic. I'll show you a little bit more about some of those investments over time. January 1st, $0. And then from there on, you can see I'm investing heavily every month. And up until March, where there was a extra $20,000 contribution, it's really been investing like clockwork each month. And then really seeing some gains from the markets bounce back generally. So happy with the performance of this portfolio so far. Looking forward to continuing to contribute. I don't think I'll be contributing at this rate forever, but I do think that a mid cap or an index fund is best set up for someone like me who's busy with a wife and kids and family and doesn't want to spend every minute looking at the portfolio. So this is not designed to be something aside from the conviction for Tesla. This is not designed to be a full-time job of investing in stocks and interviewing people and really investing. In the case of Tesla, I've read books about the company. I've really followed closely on what they're doing. In the case of the index fund, it's really set it and forget it. Keep investing month in and month out. Okay, moving on. Next thing I want to talk about was the big difference of small numbers. And this is hard to kind of contemplate because fees and small differences in our daily life don't seem like they add up or are as big a deal. I'll give you an example. If I told you I'd give you 1% more water in your cup, or you could run 1% slower or faster, you're probably like, who cares? Like 1%, not a big deal, not noticeable. I could have 1% more pizza at the end of the day. Who cares? Not a big deal. But over time, the 1% is a humongous difference. And it's one of these things that compounding has shown over time is hard to understand around. So let me show you what I mean here. Let's take a look at this chart of investments And I'll link to this in the show notes. And over on the left, it's got the years invested 5, 10, 20, 30. And it's got the typical return with a 1% cost. So 1%, 140,000 for 5 years, 196,000 for 10 years, 20 years you're seeing 386, 30 years you're seeing 761,000. If you had an 8% return with a 0.26% cost, you're looking at 145,000. So $4,918 over 5 years in savings. Over 10 years, you're looking at $14,000 in savings because of that 0.74% difference. Over 20 years, it's $57,000. Over 30 years, it's $174,000. So last week when I talked about a balanced portfolio and why I'm invested 100% in stocks in my 401k, the reason is right here. Over 30 years, that 1% difference from 9.1 in the S&P 500 with a bond mix versus 100% stocks at 10% is $174,000 over 30 years. So in my case, I plan to be invested for 30, 40, 50 years. And it'll even go greater than this. It'll even go higher. So in my opinion, it's worth the anguish and is worth the mental stress of the market going up and down to see things through and just to keep investing. So I hope that helps visualize things. And like I said, I'll link this out in the show notes. That takes us to the end of the show. Thank you so much for watching. I look forward to hearing from you. If you have any questions, please put them in the comments down below, and I'll see you guys next week.